Hello and welcome to ET Market Smart Talk. Well, I'm your host, Shadjanand, and in today's episode, we are diving deep into the fixed income market at a time when India's macroeconomy story looks stronger than ever. Well, GDP growth came in at stellar 7.8% for Q1 FY26, while inflation has cooled to a 6 year low. But can this Goldilocks scenario really last amid global uncertainties? Well, to answer this and more, I am joined with Chirag Doshi, who's the Chief Investment Officer, Fixed Income at LGT Wealth. Chirag, welcome to the show.
Hi, Kshitij. Well, thank you for having me on your show.
Thank you so much for taking the time out, Chirag. And well, India posted a stellar 7.8% GDP growth with inflation at a 6 year low. How sustainable is this growth inflation mix, in the face of global uncertainties which are having at this point in
time? Yes, Kshitij, India delivered a very strong 7.8% growth in print in Q1. Which was well ahead of expectations. And the other big positive is inflation. It's at multi-year lows, close to 2%, thanks to the good monsoons and soft food prices that were there in the previous months. In the near term, I think this mix is sustainable because consumption is resilient, real incomes are improving, and financial conditions are easy. But we also need to be mindful of risks, global tariffs that are going on, the trade frictions, and any sudden commodity shock could change this Goldilocks scenario. So short-term outlook is very positive, but in the medium term, I think the external headwinds will decide whether growth stays at these elevated levels with low inflation.
Absolutely. Now, with India's trade deficit widening due to tariffs and high imports, and recently we saw the GST cut as well, which could actually impact, which could actually cost the exchequer around about 50,000 odd crores. Do you expect policymakers to sort of recalibrate their trade or fiscal stance?
Kshitij, we are already seeing some pressure on the trade deficit, though the August numbers were a little lower than what we saw in July, but they were a little higher than the expectations that the market have. July numbers were the widest in the 8 months, partly because of higher imports and the new US tariffs. Policymakers are likely to respond, and they have also responded, but I don't expect a very big back change. I think more likely we will see some incremental reliefs from the government side, some policy tweaks, and some diplomatic efforts to diversify into other markets. At the same time, government, I think, is very, very focused on fiscal discipline. So any response will be calibrated rather than expansionary. The broad strategy will be to cushion the affected sectors without derailing the fiscal glide path that the government has chosen for the next few years.
Absolutely. And in fact, the yield curve has sort of bear steepened, you could say that, with the 10-year hitting 6.57% and the 30-year at 7.31%. So how should investors sort of interpret this move?
The bear curve steepening simply means that the long-term yields are rising faster than the short-term yields. Now, in India's case, it reflects two things. One is the heavy supply of the long-dated government bonds. And two, the term premium investors are demanding because of global uncertainty and fiscal risks. Now, for investors, the message is very clear. Volatility is higher at the ultra long end. But the 5 to 15-year segment of the curve actually looks very attractive right now. You get healthy carry, and you still have room for capital gains if inflation stays benign, which in my view it should in the next few months, and policy support comes in, which again in my view will. So the steepening is not at all negative. If it actually throws up opportunities in the belly of the curve, which I think investors should capitalize.
Absolutely. And given expectation of sort of one more repo rate cut this year, do we expect the 10-year to remain, in the range of 6.3 to 6.5%?
That's broadly my base case. Inflation is well anchored. The RBI
Mm,
has already eased a few times this year by almost
mm,
100 basis points, and the
yes.
street expects one more or at the most two more 25
Mm,
basis points of rate cut by the end of this year. If that
right.
materializes, then the 10-year should comfortably trade between the 635 to 650 or 55 zone, maybe
Okay.
even test the lower end uh,
Yeah.
uh, if the supply is managed well.
Mm,
But we must be aware of two-way risks. Global yield, crude oil prices, fiscal
right.
pressures could push
Mm,
the yield up temporarily. So the
okay.
range-bound movement with a downward bias is how I would put it at this time.
Absolutely. And with India US yield differential at 230 basis points, do you see more global inflows into Indian debt?
Yes, the differential is very attractive. The
Yeah.
US 10-year is hovering around 4% right now. India is closer
Mm,
to the 640, 650 handle. So the spread is about
sure.
230 to 240 basis points. Now, add to
Right.
that India's strong macro fundamentals and the
Mm,
upcoming inclusion in the global bond indices, which has brought some
right.
flows and it is likely to get some more flows in the near future. And the case
Mm,
for inflows is hence very strong. Of course,
mm,
foreign investors still will watch for currency risk very closely. And with the Fed now signaling that the rate cuts will be there going ahead, and tomorrow we are expecting one more 25 basis
mm,
points of rate cut by the US
sure.
Fed after the softer job reports that we saw.
Mm,
So the global
mm,
backdrop also supports flows into the emerging market debt, and India
right.
stands out as a key beneficiary of this.
Absolutely. And, finally, in this environment, where do you see better opportunities? Is sovereign for duration gains or AAA rated PSU or, IG corporate bonds for carry? What do you recommend?
I would say both, but with
Okay.
a tilt towards sovereign duration right now. And
Okay.
here's why: because 10 to 15-year government bonds are offering elevated yields at a
Mm,
time when inflation is under control, right? And the
absolutely.
government has signaled that it may reduce the long end issuance in the second half,
Ah,
which the borrowing
sure.
calendar will come soon. And on top
Mm,
of that, the markets are also expecting that RBI will step in form of open
mm,
market operations or even Operation
mm,
Twist to support the longer end of the curve. All this
sure.
creates a very favorable environment for an investor to step up on duration.
Right.
I would also complement that with AAA PSUs and top-rated
Mm,
corporates in the 4 to 7 year segment for carry and stability. So a barbell approach, I would say, is recommended at this stage. Duration for
mm,
the upside and high quality credit for steady income looks very optimal.
absolutely. Well, on that note, thank you so much for your time, Chirag. And for more updates, analysis, and expert conversations, stay tuned to ET Market. Thank you so much for your time, Chirag.
Thank you. Thank you for having me.